All right, here we are, ladies and gentlemen. Welcome back, investors, to Ticker Time News. I am Adam, and the market did bounce from an extremely oversold mark. And on our Friday live stream, we touched on this, and our prediction on Friday came true today. We set a new low for the year today on the S&P 500. So we're going to get into the stock chart here on this in just a little bit. We've got fertilizer stocks reporting, a big one, Mosaic. I know I get questions about that. So we're going to talk about their earnings, three particular fertilizer stocks, and figure out what's going on, because the war in Ukraine is affecting fertilizer stocks and the companies, right? So we're going to get into that and talk about that as well. So just remember, this is a quick take on the market, and I do try to make it as quick as possible, at least going through what happened today, why it happened, and what to expect tomorrow. But I love answering your questions. So if it does go a little bit long, just know that I'm here answering your questions, because that's what I like to do. That's why I'm doing the live stream in the first place, so I can get straight to your questions without having time or barriers in the way, okay? So if you're just looking for the quick take on the market, that'll be the first part of the live stream. And then the back half of the live stream is reserved for all of your wonderful questions. So thank you again for joining me, and let's get right into it. The S&P 500 did advance 0.6% on Monday, overcoming a late 1.7% decline. That's how deep in the hole the S&P 500 was. Even as the 10-year yield finally, and just a quick reminder, we can all do the charting together. You can do it at home using TradingView. There is a link in the description for a free account. Type in US10Y and you will get, stop hitting a T, you will get the 10-year yield. Now, we've been predicting this for a while now, that the 10-year is headed for 3%. Now that it's got there, oh man, where could it be going next? It got to 3.01% today. That is a steep run up there in the percentage for the 10-year yield. Where does it go from here? Well, it's come down now a little bit in the after hours. It's now at 2.977%. Will it continue to rise? That's the big question. I think it could. I really do. It looks like it's been running very hot. But when we add a little bit of history into the perspective of this chart, you can see that we're not at the peak yet. On 10/18, and remember, 2018, we had a big fall in the market. What did the 10-year yield do? It went up to a high of 3.25%. So, are we headed back to that area? I think we are. I really do. We're only 25 basis points away from hitting 3.25%. And if we go a little further back in time, the chart goes a little bit slower as it's loading these pools. You will see here in 2013, December of 2013, it got above 3%. It got to 3.039%. Maybe we're looking at something like that. Well, let's go back a little bit further in time. Back when inflation in the market was rotten. 07, right? The big 08 crash. In 07, it got to 5.306%. That was its high. But it was coming off of a low down here, somewhere around a 3.40%. So it was already much higher than where we just came from. So I don't think we're going to 5.3% like in 07. But somewhere between this 2013 to 2018, a 3.03, well, I mean, we almost got to that today. But a 3.25, I don't think is out of the ballpark for the 10-year yield. And let's just open this back up here and take a little better look at this run that it's been going on. it is extended right now. If we look at the 50-day moving average on this thing, I mean, it would be in a very, well, it is in a very bullish stance moving up on the chart. So let's keep that in mind. But the last time it got to almost 3%, 2.98% was April 20th. And then we had a slight pullback, and then it bottomed out here on April 26th and April 27th. And just over the past few days, it's been rising. So we're already pulled back from that 3% just slightly. All right, going back over the rest of this. Oh, one thing to mention, if you didn't catch it on the chart when we went back in history, the 10-year hitting 3%. This was the first time that it's hit 3% since December of 2018. I meant to point that out when we were going back and looking at the chart. Now, the Nasdaq today, let me pull up the chart for the Nasdaq. It also did a major reversal from its lows. Here's the Nasdaq. It was up 1.72% to finish out the day. Nice bounce from, again, a new low for the year. So we've got lows being made here for the Nasdaq on the 24th of January, another low the 24th of February, another low on the 14th of March, and then we made a new low today. We broke below this line right here where the past two lows are or have lined up. So this purple line here, it did dip below it, but it closed above it, which is a promising sign for the Nasdaq. And I'll tell you why in just a moment when we dive further into the charts. Now, the Russell 2000, it did a little bit better today as well. It was up 1%, and of course, it made a new low for the year. Ah, boy. And the poor old Nasdaq and the Russell 2000, they are down bad for the year. But the Nasdaq is out of its bear market, right? 20% and breaking that 20% mark. But I'll talk about that in just a moment too. Okay, last we have the Dow Jones, and here it is on the chart. It did not set a new low for today or for the year. It did not set a new low today for the year. It was up 0.3%. Its low right here on the chart, 32,449 was the low for the day. But if we go back here to February the 24th, the low was 32,272. So not quite there. Couple hundred points and it would have. This is, I would say, interesting. The other three indices did make new lows for the year today. The Dow didn't. Does that mean the Dow's not out of selling pressure territory for the short term, right? Like over maybe a couple days of this week. It'll be interesting to watch. It is interesting that the Dow was the one that lagged behind the most, only being up 0.3% on the day, after everyone else made fresh lows for the year today, but then had tremendous rebounds. Now, not to take away from the Dow's rebound, because it did go from 32,449 to 33,061. So, that was a bounce, but not as big as everyone else. Now, I'm going to go back to the SPX here. This is what the market did today. It fell, made new lows for the year, except for the Dow Jones, and then rebound significantly for the first trading day of May. As we, April, that was a worse month. It was pretty bad. But we seem to have picked up from the lows of April, setting new lows today and intraday, right? And then bouncing off of that. We literally took the path. I'm getting tongue twisted here. Nerves of this live stream. It always gets to me, right? Since day one and still today, live streams make me nervous. Okay. The market today took the path of least resistance and remained on the downside as investors worried over the negative price action, rising rates, growth prospects, a shrinking GDP, which, hello, we didn't think that we would have to deal with until maybe later in the year, like the fourth quarter or early 2023. But we have it. GDP shrunk, annualized in some rounding, to 1.4%. We talked about that when the data came out last week, but that was on investors' minds, as well as the elephant in the room, the big thing everyone's talking about, the Fed's policy decision this week. They meet on the 3rd and the 4th. That is tomorrow, Tuesday, and Wednesday. So on Wednesday, we will have some sort of a decision, maybe a game plan for the next several quarters. Now, I've heard some pundits say that, well, because GDP shrunk by 1.4%, the Fed's not going to be as aggressive. Well, the Fed's mandate isn't about the GDP right now. The Fed's mandate is about unemployment and inflation. Right now, unemployment is okay. They're not worried about it. It's under 4%. Inflation, they are worried about. It's at 8% or higher. So the Fed's mandate has nothing to do with GDP right now. The Fed's mandate is inflation, and they will fight it. They will raise rates. On Wednesday, we will get a 50 basis point rate hike. 50 basis point rate hike. After that news comes out, investors may settle down for a little bit. Okay, we got what we expected. They weren't overly bullish. They didn't go to some crazy 75 basis point rate hike or a whole percentage point. So we may get a little relief rally after Wednesday's news, because on March 14th, 15th of this year, let me go back to that on the calendar here. March 15th was the start of the snapback rally. So right after the Fed meets or on March, after the Fed's FOMC meeting, same exact meeting that they're having this week, happened in March, we got our snapback rally. Huge gains. Several days of gains. Will we see that after this Fed meeting? I don't know if we will, because the Fed may give us a game plan. See, we didn't have a game plan after March's meeting. We got a 25 basis point rate hike, which isn't that bad. It's not a 50 or 75 basis point hike, if you get what I'm saying. So, at this Fed meeting this week, if we get a 50 basis point rate hike and then the Fed comes out and tells us that at their next meeting, they're going to do another 50 basis point rate hike, the next meeting, 25, and we'll take it from there. If the Fed does that, then investors may see that, oh, the Fed's got a plan. Maybe we can take the market on a little joyride and up the mountain a bit. Possibly. I think a game plan is probably the most, the best news that could come out of the meeting. Now, if the Fed does go with the pundits that say, oh, because GDP shrank, the Fed's not going to be as hawkish, and then the Fed makes a turnaround and says, oh, we're going to take this we're going to be a little more cautious with this, only a 25 basis point rate hike this time. That's not going to stop inflation, but that would give the market a chance to rally. And right now, the Fed is not your friend when it comes to the stock market. The Fed's not going to swoop in, I don't believe, and save a stock market from being down 20%. And right now, the S&P 500 is down 12.8% year to date. So even if the S&P drops by 20% year to date for this year, I don't think the Fed's going to step in, even at that big of a discount. or drop, however you want to frame it, right? How you want to look at it. All right, let's keep moving on because the Fed, that's the big decision this week. Now, the market, it did turn around in the last 75 minutes of trading action today. And if we go to the 5-minute chart, we can see that the Fed, I'm sorry, not the Fed, the market, right? It had this big sell-off on Friday. We got a little bounce at the open, but then a further sell-off, dropping hard. But then the market became extremely oversold. So even with bear markets, even when the market is going down, you still get occasional rallies. And that's what happened today. The market became too oversold, too cheap, and it was a nice trade setup. It was a trade that we took during or using, we were in SPXS this morning, rode that down this morning, and then once it turned around, right? Once it turned around right here where it peaked today, because this is the S&P 500 short. So this was rising as the S&P was going down because it's an inverse. As soon as we hit this peak right here, that's when we jumped out. And then we hopped over to SPXL, which is taking the S&P 500 and going long with it. And rode that baby from around $85 all the way up to $90. It was a great ride. A great ride. And since this is an inverse, I'm sorry, this one's not. The short is an inverse, but this, since it's a leveraged, both of these are leveraged by 3 times, okay? So even though the market had dropped and we rode that and then we switched and hopped over to taking it long, we got a nice 7.34% gain from that transition and that nice rally into the close. Right now, I am still in the long position because the market, to me, still looks oversold. Now, on the 5-minute chart, you can tell that this rally that we had in the last 75 minutes of trading produced an oversold reading right here, twice. On the RSI, once, and on the money flow, twice. Okay? So it would have probably been good to take profits right there at that $90 a share level. And then let's see what happens when the market opens tomorrow. But just to be transparent, I'm still in the long position, holding it overnight. I'm not sure if that's a smart move or not, but we will all find out. We will all find out shortly in just a few hours. So on Friday's show, let's go back to the daily view here. Well, real quick, just to finish my thought on the bounce here at the end of the day. This occurred because there was no specific catalyst to account for this move. Zero. But sentiment had gotten too bearish. Buying opportunities had gotten too good. The market was just too oversold. And that's what I believe, triggered the bounce. Now, I don't think it can go much higher. I think we're limited to this yellow box tomorrow. I think we're limited to this yellow box the first half of Wednesday. But once the Fed speaks, then we'll have a better gauge on where we're going. But I really don't think we're going outside this yellow box Tuesday and Wednesday morning. I could be wrong. I'm not always right. My opinion, not financial advice. Just add it to your theory your hypothesis on the market and on trading. But with the S&P 500 falling to its lowest level this year, right, it broke the February 24th low. This is interesting to me. Now, the S&P 500, it did break to a new low this year. And let's look at these three red circles, okay? We have today's red circle right here. We have the red circle on February the 24th and the red circle on January the 24th. I'm going to hide volume for just a moment and get in here a little bit tighter so you can see this, okay? So here on January the 24th, we got a low and we had a nice rebound that day. The wick is longer under the candle and we got to a low of 42,222. And we got a little rebound off of that on the same day, traded sideways, then had a rally, right? Now, on the February 24th low, that was 41,114. We bounced off of that, had a nice rally on that same day after breaking that low, and then had a rally for the next day, then moved sideways, then sold off. But here, this is interesting. From the February 24th low, the middle red circle here toward on the bottom, when we go to the low of March 8th, it's a higher low. And then we go to the low on March 14th, it's a higher low. So we were already gearing up, making higher lows here and lower highs. We were being put in a wedge pattern, which then exploded with our snapback rally. Now we have set a new low. The wick is long on the bottom of the candle. We snap back nicely. But the candle itself is smaller than the candle of February 24th and January 24th. We didn't get as big of a gain to the upside. Now, after looking at those two scenarios, what I was thinking is that within the next 3 months, give or take, that we could come and hit a new low down here touching this purple line. That's, you can see going down, because that's where we hit on January 24th and then February 24th, connecting those together. But remember, a trend line is not a trend line without 3 or more contacts. We only have 2. So if we go from the high of the year, and if we go down 20%, we go down 20%. I want to get it right there, right there. If we go down 20%, if the Fed comes out and does something that totally catches the market off guard because they're being overly hawkish, the market will sink down to this purple line, and the market then will be 20% down from its high set on January the 4th. That's a probability. I think it's a smaller probability right now, but it's a probability. But I do think as time stretches out over the next 3 months or so, I think it's possible that we could come down here to 20%, but maybe it's way over here. Let me get that right on there. One more click. There we go. Maybe it's somewhere over here, right? But then this tool, this trend line would be much further down if that was the case. I want to make sure I got it lined up here right. There we go. So that's a scenario. But without that purple line, we did make a new low, so we could rebound off of this low for a little bit at least. Tomorrow, I don't think there's going to be too much action. We could be green tomorrow because the market, it's just oversold. But on Wednesday, that's when we'll get the real news that will move the markets. And we'll either rally because of it or will drop because of it. So keep that in mind. Wednesday is the big day. What happens tomorrow, it's a coin flip, quite frankly. Okay, a bargain hunting mindset lifted the S&P 500. Information technology, that was the sector, up 1.6%. Communication services, they popped 2.4%. Consumer discretionary, 1.4%. Those were the sectors that were at the top today, accompanied by the high-flying energy sector, up 1.4%. The defensive sectors, real estate down 2.6, consumer staples down 1.3, utilities down 1, and healthcare down 0.7, and materials, can't forget them, down 0.3. Those were the weakest sectors with the weakest performance today. And that's because once the rally occurred, once the flip was made, right, people jumped from defense into better stocks to ride this wave that we had today. Even Disney went for a ride, and that thing has been hitting 52-week low after 52-week low. All right, growth stocks, they performed fairly well. Despite the 10-year rising, which did hit 3%, we talked about that early on, it was up 11 basis points, but more surprisingly, the Treasury yield curve steepened due to the 2-year yields. It rose by 4 basis points. US0 to Y. So look at that on TradingView. Look at that. Yeah, my red drop-off didn't quite occur. We got a rally instead. So see, I'm not always right. I leave that there to remind you guys. But we've got a very flat sideways moving. It was only up by 4 basis points. My apologies. 4 basis points. It got to 2.73, and that's where it sits right now. It's barely budged. Now, despite relatively disappointing manufacturing data out of both the US and China, briefly, the April ISM manufacturing index, it decreased to 55.4%, excuse me, from 57.1% in March. China's manufacturing PMI at 47.4 fell deeper into contraction territory amid the COVID-19 outbreaks that are happening there. Now, we'll talk about those more in just a moment. Now, on a related note, Beijing reportedly tightened coronavirus restrictions on Sunday, which is going to continue to hurt supply chains. Apple, ticker symbol AAPL, it increased slightly today, 0.2%. It had a nice bottom wick, so it did have a nice bounce. And then Amazon, ticker symbol AMZN, it also rose by 0.2%. But both of them increasing by just 0.2%, was holding down, was holding back, because those are behemoths of companies, and they have a lot of weight in different sectors, in different ETFs, and on the market in general. But it held down the 1.3% gain in the Vanguard Mega Cap Growth ETF, ticker symbol MGK. If Apple and Amazon were allowed to run a little bit more, then so could this ETF. But mega caps have been one of the biggest hard to read right now, right? Nobody would have expected Apple to come out and then drop because of, if you remember, last week, both of them reported earnings reports and their stocks sold off. Nobody could predict that. But they have such big overreaching effects on the market that just those two companies alone can hold back this ETF, the Vanguard Mega Cap Growth ETF, from really getting some gains today. Now, 1.2% was pretty good, but it could have been better if it weren't for Apple and Amazon. So keep that in mind too when you're ETF shopping. They have an oversized effect on ETFs, markets, and sectors that they're in. Now, Apple did receive a notice from the European Commission of its preliminary view that the company abused its dominant position in markets for mobile wallets on iOS devices. And Amazon was removed from the best ideas list at Webbush today. Ouch! That didn't help either one of them today. Okay, WTI crude futures, they increased 0.1%, but that held the price at $105 a barrel, and I believe it was 11 cents. So still at 105, just like it was on Friday a barrel. All right, let's quickly review the economic data, and then we'll get to your questions that you have, and also the fertilizer stocks, Mosaic. I want to talk about them real quick as well. All right, so the data we got today on Monday. We got the April ISM Manufacturing Index, and it decreased to 55.4% from 57.1% in March. Now, a number above 50% does suggest expansion. If it was in the 40s, like China's number was, then we're not expanding anymore, we're contracting. So at least that's a good sign. We're still above 50, but we dropped from 57. So it did contract a little, but still growing, just not at as fast of a pace, right? April marked the 23rd consecutive month of expansion, though, in the manufacturing sector. Although the April reading is the lowest since July of 2020. The key takeaway from this report is that manufacturing activity is being held back by COVID issues abroad, ongoing supply chain problems, inflationary pressures, and labor constraints that have made it challenging to satisfy demand. Then we got to read on the housing market with construction today. Total construction spending increased by 0.1% month over month in March, following a 0.5% decrease in February. So if you add that gap, that spread together, it was a 0.6% increase, right? The 0.5% decrease from February, and then the 0.1% increase in March. That's a 0.6% spread. So it did pick up, which is good. We need housing. It's a big problem. Affordability is the biggest problem in housing right now. Now, total private construction, because we've got private and then we've got public, but total private construction did increase 0.2% month over month, while total public construction decreased 0.2%. So it was a draw. Now, on a year-over-year basis, total construction spending was up 11.7%. The key takeaway here is that other than residential spending, there wasn't much strength in spending activity in either of the private or public sectors. Now, looking ahead, investors will receive factory orders for March and the JOLTS, which stands for Job Openings Report for March tomorrow. So we'll go over that data too tomorrow. Here's where we stand year to date. The Dow Jones is down 9%. The S&P 500 is down 12.8%. The Russell 2000 down 16.1%. And the Nasdaq down 19.9% year to date. The Nasdaq is out of correction territory. Bearish territory. Bear market territory. Oh boy, you can't help but try to find something to laugh at when things do get bad, right? Laughter is the medicine to cure all ailments, right? So the Nasdaq being out of technical bear market territory, which is at 20%, 10% is technical correction territory. It's a good thing. Okay, let's look at some of the fertilizer stocks right quick. Let's see here. Well, actually, before I get to the fertilizer stocks, hold on one quick second. Let me look at this question here. Today was crazy. Yes, it was. All right, should we see a rally? Let's get this up on the screen here too. Should we see a rally if a 50 basis point hike is announced? Right. What else could throw off the market into a sell? All right. So we talked about this very beginning, but it's okay. We can go right back to this. Let me put the S&P 500 up here. I use ticker symbol SPX when looking at the S&P 500. Here's the scenarios that I think could play out. One, we got this nice bounce from an incredibly oversold market today. We could see green tomorrow on Tuesday when the FOMC meeting begins, just because the market is oversold. But I don't think it will be a huge run. I think we'll be in this yellow box. Even if we turn red tomorrow, I still think we'll stay in this yellow box, right? So tomorrow, I think, is a coin flip on whether it's green or red. I'm leaning a little bit more towards green just because the market is oversold. But that doesn't mean that we have to be green. Now, on Wednesday, the 4th, may the 4th be with us, that's when the morning, the market will probably be flat. In the afternoon, when we get the press release and then we get to hear the Fed speak, that's what will change the market from being flat to going up or down. Now, if we get our 50 basis point rate hike, I think the market will say, okay, we got what we expected. Let's put a little gas in the tank and cruise up the mountain. That could give us some green in the market. If we get a 50 basis point rate hike and a plan for the next couple of meetings, which I'm not sure they will do, but I can always be hopeful, right? If we do get a 50 basis point rate hike and then we get, okay, next meeting, we're planning to do another 50. And then the next meeting after that, which, let's see here, I got them written down. Just move a couple things out of the way here. We've got June, we got July 26 and 27. So if they say in July, we'll do another 50 basis point, and then we have a meeting in September, the 20th and 21st. If they say we'll do a 25 basis point rate hike and pencil it in, but it depends on how things are going, I think the market will see that plan and say, oh, that's not that bad. That's not that bad at all. Let's put a little extra gas in the tank and go up the mountain further. I think that would be a probability. Now, if, for example, we get a 75 basis point rate hike tomorrow, I mean on Wednesday, on May the 4th, then the market will drop because the market's not expecting that. If we get a 50 basis point rate hike and then the Fed says, well, next meeting we'll do a 75 basis point, the market will be red. So it all depends on what's on that press release and then what the Fed says when they speak. We are anticipating a 50 basis point rate hike on May the 4th, which is Wednesday. And if we get that, the market will say, that's what we expected, okay. And then, like I said, a little gas in the tank, and we'll go up the mountain a little bit. But anything other than that, like, for example, if the Fed says, and this is a tough one for me to believe, but if the Fed, for some reason, only did a 25 basis point rate hike, And their excuse, because I've heard some pundits say this, but I just find it hard to believe, and their reason for only doing that is because GDP shrank on an annualized rate of 1.4%. That one would be a tough one. Like, Fed, do you know you're behind the curve on inflation? Do you know that you have missed your opportunity to do a soft landing and bring inflation down? Do you realize that? Because the Fed has lost credibility at this point, and they have to build back credibility because they've lost it, because they lost inflation. One of their two mandates they failed on. So the market would probably be like, oh my gosh, the Fed doesn't know what they're doing if we got a 25 basis point rate hike on Wednesday, May the 4th. So May the 4th be with you and be with me and be with all of us. May the force lift us and keep us safe. Too much Disney branding, huh? Okay, but that's my thoughts there. Got it? Great. Awesome. I know it's still early, but is the CPI report expected to be higher or lower than 8.5%? All right, let's hide that and let's go up here. Right now, let me pull up. And we can do it on the chart here too. I forget what the ticker symbol is for this. USCCPI. So here we go. This isn't it. What am I? US. I forget what the ticker symbol is. Is it USCPI? There we go. USCPI. I should have just gone with what I thought. Okay. This big rise right here isn't good. Hold up. Okay. If we get anything, I'll have to write this ticker symbol down so we can look at it. It's important that we get it. This isn't the right ticker symbol. I have to find the right one. So excuse me for missing the ticker symbol in this. Right now, 8.5% is what's expected for March. So that's not good. It's not good because for the Fed to really get inflation under control, we're going to need to be closer to 4 or 5% on the Fed funds rate by the end of the year. And for that to happen, then the Fed's going to have to raise 75 basis points a couple of these meetings, which would just shake the market and send it down. But like I said at the beginning, the Fed's not worried about the market falling. If the market fell 20%, the Fed wouldn't worry about it because that's not the Fed's mandate right now. The Fed will not swoop in and save us. Those days are long gone. The Fed's got to get inflation under control. And a 25 basis point rate hike last time, it did nothing to inflation. So with your question, I know it's still early, but the CPI report is expected to be higher or lower than 8.5%. No, it is expected right now at 8.5% to answer your question specifically. 8.5% is the expectation for inflation right now. But the Fed, I've lost my thought there. The Fed is just behind it, and the 25 basis point rate hike that it did nothing to bring inflation down. That's just the point that I wanted to make. Looks like my stocks will come back just in time to enjoy, what is that one? Just in time to enjoy a $47 loaf of bread. Oh my gosh, man. The Fed is just so behind it, isn't it? It's just so interesting. Well, not interesting. It's a shame that the Fed is behind it. Oh, Devin, you asked a question about Cathie Wood and her stocks. In my Friday quick take, which wasn't a quick take at all because we talked for hour and a half, I went over in detail about Cathie Wood and her stocks and what I think. To boil that down real quick, of her top 10 in ARK-K, the top 10 stocks in ARK-K, I believe that 60% of them are good for 5 to 10 years down the road. But the point I think I was trying to get at is where could the stock be headed? Where would be a good entry point? And on Friday's live stream, we determined that it's in an entry point right now. It has just begun to enter. That's what this green box is here. This would be, I think, an entry point. 60% of the top 10, I think, can do good in 5 to 10 years from now. Tesla is going to be one of the biggest, again, like it was in the past. But this area here, a support area right around $35 and resistance, well, not resistance. That's wrong for me to say. This would be my buy box, okay? Anywhere between $35 and $50 a share, and I know it's a $15 spread, that's an area of interest for ARK-K. And if we go back and look at where ARK was back in December of 2017, leading up to the pandemic, of February of 2020, this is the box where ARK-K was trading before Tesla went to Mars. So now that it's come back down, I think this area, this green box between 35 and 50 a share is the entry point that we'd want to be looking for if you believed that Cathie Wood's ARK-K holdings will do good in the next 5 to 10 years. And I believe that 60% of the top 10 is good for 5 to 10 years out. Okay, you'll check it out. That's fine. I kind of just went through it real quick, just right there for you, so you don't have to go back and watch it if you don't have time. But I did go individually into her fund and each stock, and kind of just gave a quick little synopsis there for the top 10 holdings. But that's it right there, boiled down. I believe that 60% of her top 10 is good for 5 to 10 years out, Tesla being the #1 reason why. And this buy box right here, $35 to $50 a share, I think is the best place. Put it average somewhere, around $40, $42 a share in the middle of that to average it out. And I think that would be an ideal position to stock up for the long haul. I'm in for the long haul, already holding around 70. Not that worried yet. Yeah. I don't believe unless we had a big crash in the market that was broad-based and sweeping, that we would see support around $35 being broken. At least I wouldn't think so. But the market, and see, with growth stocks like Kathy's growth stocks in her portfolio, growth ETF, a lot of people are hammering her because the stock has dropped. But I mean, you go and look at any growth stock. You know, I'd give her a hard time on holding Teladoc Health. And I went through it in the live stream on why Teladoc Health, I don't think, is a 5 to 10 year stock. I think Teladoc Health is maybe it's a generation stock. Teladoc Health is not something that's going to, you know, rebound like a Tesla will in 5 to 10 years. That's going to be 20, 25 years down the road. And I look at it firsthand. I'm in a wheelchair. You guys know that. So going to doctor's appointments is difficult to do. I love doing virtual. I think it's great. But who's the generation right now going to see the doctor more? It's definitely not the younger generations. It's the older generation, the baby boomers. They're the ones going to the doctor. They didn't grow up with technology like Generation X did, or Gen Z, or millennials. They grew up with technology. Boomers, baby boomers, did not. So the idea of them using virtual reality, video conferencing to talk to a doctor, it's not something they're comfortable with doing. They would much rather go visit the doctor face to face. I mean, there's certain things that I would much rather go and visit the doctor face to face to talk about. I'm fine with, getting my prescriptions done through virtual, but sometimes you just want to be in front of a doctor face to face, especially for test results. And that's just not something that boomers would do right now because they didn't grow up with technology, if that makes sense. I hope it does. And that's one reason Teladoc Health, it sank hard. Just because they're a little too early, right? Of course, the pandemic was wonderful for a company like Teladoc Health, and it got their foot in the door. And their foot will remain in the door for a generation. And then once the older generation ages out gracefully, and the next generation comes in to fill the void, they'll be more technology inclined. And doing virtual appointments will be more natural to them. So I think she should just lower her position in Teladoc Health, but she's just so far in the hole on that. Sorry for rambling on. I know that's not what you guys really want to hear about. All right, I do want to talk about Mosaic and two other fertilizer stocks because they did report earnings today after the bell. And fertilizer, it's important to agriculture. It's important to food production, food yields, our corn, our soybeans, our wheat, your $47 loaf of bread could be more if fertilizer prices are higher. because maybe farmers won't use as much nitrogen as they should to grow their wheat, and their wheat yield will decrease because of that lack of nutrient. The nitrogen won't give the wheat the yield that farmers are used to. So if prices get too high, that's the only thing farmers can do. Either not plant, because they don't want to just plant food to break even. They want to plant food so they can keep their farm in operation. And of course, feed us and the world along the way. So with that being said, I do have a couple of them here already pulled up. The first one, which reported the latest, I didn't think they were going to report. This is Nutrien. I believe that's the pronunciation of it. Their headline, Nutrien delivers strong first quarter results in response to global supply uncertainties. That is the key word right there, uncertainty. There's a lot of uncertainty right now in farming. There's a lot of uncertainty with farmers questioning, are we going to get our potash? Are we going to get our nitrogens? Are we going to get our phosphates this year for our crops? So there's a ton of uncertainty. And the reason the uncertainty is so big is something that Mosaic talked about. And we'll talk about what they said. All right, so I want to go here first with Nutrien. I believe, again, that's how it's pronounced. So I'm going to pull the chart up here. Did I get that wrong? Just do it this way. All right, ticker symbol is NTR. NTR. Now, you'll see here that they have just been running the past couple of months, had a nice rally in February, the end of February, all the way up to this peak that occurred on April the 18th, so midway through April. And then a couple big sell-offs here, big sell-offs, nothing to do with earnings there. Now, they're up about 1% today, including what occurred in the after hours. So we got $2.80 on EPS, which was a beat by 4 cents. Revenue $7.731 billion, and that was a 1% beat right there for their earnings report. So revenue, I believe, grew by 65% year over year. And of course, they beat. Now, they reported, a record net earnings of $1.4 billion. And you can see that net earnings number right there. But that was a record for them. And their adjusted EBITDA of $2.6 billion in the first quarter of 2022 was due to higher realized prices and strong retail performance. Now, they also raised their fiscal year 22 guidance. Now, on the stock chart, they're bouncing around their 50-day moving average, and I can see them going higher as the war in Ukraine continues longer, right? I can definitely see that occurring. Now, Intrepid Potash, which is another one, IPI is the ticker symbol. Intrepid Potash. they have been on a big decline, right? Now, this one was down today. Even with the big rallies we had today, they were down 1.46%. They reported their Q1 earnings with EPS of $2.31 a share, and they beat by 8 cents. On revenue rose 46.1% year over year to $104.4 million versus the expected $90.88 million. So they beat on revenue as well. And if we go look, let's see here. Maybe it's up here at the beginning. They have a new potash area opening up, and that's expected in Q4 of 22. Upgraded some brackish and deep brine wells. That's expected in Q3 of 22. So they'll have some more capacity at the end of the year. But that's not when farmers need more capacity. They need it now. Let's see here. They'll have an improved injection pipeline in the first half of 23. Those are some key things that I think are important, because we need more capacity right now, because we need to bring prices down so farmers can farm and have what they need. Now, Mosaic is the one I want to spend the most time on, because that's a very important company to U.S. farmers, especially. Also, they're South America. They have a big reach. Now, from last quarter, being a miss on both EPS and revenue by over 1.5% on revenue, they still rallied because prices were continuing to go up. Well, they beat this time. Now, here's what Mosaic had to say that was most important, I think. They reported their Q1 earnings of EPS $2.41 and per share, and that excludes any non-recurring items, and that was 1 penny worse than expected. Now, revenue rose 70.8% year over year to $3.92 billion, but that was just shy of $4 billion expectations. So revenue grew by over 70%, but that still wasn't enough to meet expectations. That shows you this market is just volatile and crazy. Now, adjusted EBITDA totaled $1.45 billion, and that was up from last year's total of only $560 million. So a huge, almost doubling there. Now, the company did generate cash flow from operations of $506 million and free cash flow of $466 million. Now, here's the important part here, I think, for Mosaic. Global agriculture markets. They are reflecting the impact of the conflict between Russia and Ukraine. Together, these countries supply more than 25% of the world's wheat and barley, 16% of the corn, and 24% of sunflowers, and more than 75% of global sunflower oil. That's a lot. That's going to affect a lot of products. Now, the supply uncertainty created by the conflict continues to drive grain and oilseed prices higher, which were already elevated prior to the war beginning as a result of the 20-year low in global stocks to use ratios. I found that fascinating. I did not know that. Now, the conflict is also impacting fertilizer supply. Russia accounts for 20% of the world's nitrogen, phosphate, and potash exports. So farmers may not be getting that. When combined with Belarus, which is allied with Russia for the most part, 40% of global potash supply is at risk. That's a lot. Russian exports of all three nutrients have declined since the beginning of the conflict, and sanctions against Belarus remain in place. For both potash and phosphates, supply chain constraints and impacts related to COVID are only just beginning to let up. Disappointing rail service in North America experienced during the first quarter has improved, but is not expected to reach normal performance until the second half of 22, after farmers already need these products. Now, like I mentioned about South America, in Brazil, road and port congestion is slowing deliveries, though Mosaic continues to benefit from access to its own private ports, significant inventory or sufficient inventory they have, significant volumes, and in-country market positioning. These issues, combined with the current global supply and demand situation, point to persistent tight markets for both phosphates and potash. So that's Mosaic's words on what's going on. Farmers need these products. And if we don't get them, if the farmers don't get them, then yields will be lower. And that $47 loaf of bread might not be too far off. Hate to say it. Another very important fertilizer company does report earnings tomorrow. That's CF Industries. The ticker symbol is CF. It'll be interesting what they have to say. They did beat on their last quarter, but that doesn't mean much. A 7.7% surprise on EPS, but nearly a percentage point miss on revenue, 24 million. And they have an estimated EPS of $4.35, an estimate for its revenue of $2.6 billion. We'll see where they come in at. Now, over the past 4 earnings, they've only missed 1, which isn't bad. Last quarter, their profit margin dipped, or 2 quarters ago, my apologies. 2 quarters ago, their profit margin dipped to a loss. Their net income dipped to a loss, but they rebounded in their last quarter, Q4 of 21. Revenue of $2.54 billion. Look at that revenue. The revenue just took off, and that has a lot to do with rising costs. Now, CF Industries does report tomorrow, if I didn't mention that already. My apologies, not tomorrow. Tomorrow's Tuesday. Wednesday. They report earnings on Wednesday. So there'll be an important one for the fertilizer investors out there, or anyone interested in how farmers are going to get the nutrients they need to produce the yields that they need to produce in the plants that they grow. All right, so I have gone over a whole bunch here, live for an hour. Sorry again, this was not a quick take. Like I warned at the beginning, these are supposed to be quick take videos, but I love your questions so much that the first half of the video is the quick take on the market. The second half of the video is, of course, answering your questions and just talking about the markets in general. So I hope you get value out of this. Just remember, if there's anything that I can do for you, let me know. You are welcome. You are welcome. And again, we are here. I am here every day the market is open, after market close, to talk about what happened in the market, why it happened, and try to get a game plan, talk about tomorrow. A lot of earnings this week, a whole bunch of earnings this week. So just be on the lookout for that. And of course, we will get on Wednesday the Fed speak. I expect tomorrow is a coin toss on whether it's red or green. I'm leaning towards green because the market is just oversold. And we did close today above Friday's close. And in the technical sense of technical analysis, that is significant. So that's important. All right. If that's it, I will wrap it up here. Thank you guys for joining me. Help me out by smashing that like button, sharing this video wherever you can, and click the first link in the description or the link in the live chat and join us there. And yeah, we would love to have you over there for sure. After FOMC, what other things should we look out for? That's the biggest one. And then inflation reading, jobless claims, your CSI, a CPI, excuse CSI. What am I thinking? Crime Lab? Your CPI, your PPI, producer price index. Those are your two big reads on inflation. They always move the markets. I'm also watching the VIX on TradingView. Just type in VIX in the top one there. I'm watching the VIX right here. And the reason, oh, I clicked on the wrong one. My notes aren't on this one. VIX, CBOE. Okay, the VIX. I'm watching the VIX because here on the VIX, if I scrunch this up, the red circles, right? Whenever the VIX gets into this area where the red circles are, there's always, at least going back to March 2020, when the market just, completely sank because of COVID. But since that big rise from COVID in March 2020, whenever the VIX gets into this area where the red circle is, the VIX always turns its direction, right? The markets flip. And if we look here at the last time this occurred, whenever the VIX, and the numbers here that I'm looking at for the VIX are 34 up to 37. Whenever the VIX gets in between those numbers, 34 and 37, it makes a reversal. Now, the VIX got into this area today. The high on the VIX today was 36.6. It was well inside this area. So I can actually now take this red circle here. How do I get to it here? Here we go. And I'm going to copy it, and I can now put this red circle wrong button. Oh, come on. There we go. There we go. All right, I can now move this red circle over here. We got a new circle to look at. So the VIX did get into this circle today, and we got our reversal. Now, there's a lot of times when there's big wicks that get in here, but that's not the bottom of the market. So the one thing that I would say about this is the candle is kind of close, and the candle is inside this circle. So this may have been the bottom that we saw today, looking at the VIX and the data we have for the past 2 years. So that's also what gives me, when I say it's a coin toss tomorrow, but I'm leaning towards green. This is why I'm leaning towards green. The market is oversold. Yeah, there's so many crazy observations to be made in this market. It is just sometimes unreal. Unreal how things connect. But yeah, there's the history for the past 2 years of the VIX, and every time it gets in that area, you know, call it 35, and it got above 35 today, the market reverses. Because when the VIX then comes down, because fear is at its peak at that point. And when fear peaks, markets bottom. So just something to watch out there for. All right. You are welcome. So that's what I'm watching. Your question there, after FOMC, things to be watching. Really, I'm just watching inflation and fear in the market. Those are the big ones. And then, of course, all these earnings that are coming out, just keeping an eye on them for any big movers that could affect the market overall. All right, and just a quick reminder, right now I am long the S&P 500. I am in the SPXL right now. I hopped into this when the market made its switcheroo. We go to the 5-minute chart on this. When the market made this switch here, right about $85 a share and some change, I went from short to long in the S&P 500. The VIX helped me out to make that call too. So that's where I am right now. And we'll be watching the technicals on this, and we'll talk tomorrow. All right. Do make sure that you click the like button, share this video, and click the first link in the description. I'd love to see you there, and I think you'll enjoy what we have to offer. All right, ladies and gentlemen, thank you so very much for watching, and I will see you in the next video. Thank you, and good night.